Let's walk through a simple but powerful income strategy using long-term call options instead of shares of stock. Suppose we're looking at TLT, the iShares 20 plus year Treasury bond ETF. Back in January, it was in a prolonged downtrend and trading around 87. Imagine we buy 10 long-term call options, specifically the January 2026 76 calls. That's deep in the money and gives us strong exposure to the upside. At the time, they cost about $12.55 per options contract, so the total investment is $12,550. Simultaneously, we sell 10 short-term calls, the 88 strike call option expiring in February 2025. That brings in about $11.80, lowering our total net cost to $11,370. This is called a diagonal spread, where we've used a long, deep in the money leaps call combined with a short, near-term call that's just out of the money. By the February expiration, TLT has moved up slightly, closing at 89.61. That means our short 88 calls expire with $1.60 of value, and our long 76 calls have grown to $14.52 each. After closing both sides, we walk away with a tidy 13.6% profit in 1 month. We repeat this in March. TLT is now around 89.61, so we sell the March 90 calls for $1.13 and roll our long calls up to the January 2026 78 strike, costing $12.85. At March expiration, TLT closes at 90.70. The short 90 calls are worth 70 cents, and the long calls have grown again, netting another 10% gain. We run it again in April. This time we sell the 91 calls for $1.16 and buy the January 2026 80 calls for $11.93, but TLT dips to 87.53 by expiration this time. The short calls expire worthless, so we keep the full premium. Our long calls drop in value, but since we didn't sell them, that's just a paper loss for now. Across these 3 months, we banked $38.70 in realized profit on an average capital base of around $11,000, an average return of over 10% per month. This diagonal approach is a great way to extract monthly income from a long-term directional bet without having to time the market at all.